Hello again, everyone. Happy New Year. It's 2021, and the year has certainly started off in a wild way in many ways. I ended last year by saying in our last market update, actually, that I thought I was listing what could go wrong. One of the things that I listed first was that there would be a clean sweep of the Democrats into both the House and the Senate. And of course, that happened. And yet the equity market did not seem to think that that was a very bad thing at all. And of course, I'm focused on the longer term tax rates, especially capital gains tax rates and corporate tax rates. So we'll see what happens there. I do think they will go up, and that will not be good. But in the meantime, the market seems to be focusing on the stimulus and the odds that we will have at least another $1 trillion of stimulus. And so the market is running with that. And it's both cyclicals and growth stocks. So that's somewhat unusual. So it's the bull market is broadening out. So I can say I was wrong about what I believe the impact on the stock market was going to be, certainly in the short term, and I hope in the long term. So that's the first way I'll open this up by explaining what I did not get right. Always important to do that. What we did get right last year, and we believe this will remain true this year as well, is the V-shaped recovery. Now, we're probably going to go through some wobbles here because of the resurgence in the coronavirus, both the infection rate and the fatality rate. So I think that could put some fear, already is putting a lot of fear back into the system. And really causing turmoil in a lot of lives. So some stimulus to address that part of the population, we would agree, is absolutely necessary. Nonetheless, we think that the forces in motion, and which started last year, are still in motion, and that the equity markets are basically saying they will continue through this year. We think we're in a very strong recovery on balance, with the occasional wobble as we negotiate the coronavirus. We think there could be an earnings explosion, and we're already seeing the surprises relative to expectations. They are some of the biggest surprises I've ever seen in my career relative to expectations. And last year, we believe the S&P 500 delivered $100 in earnings on average for the year. The year before, it was $140. Now, the fourth quarter estimates are coming up rapidly, and we will get those results. So we were probably north of $100. But now it is looking like, given the momentum exiting the year, that earnings in 2021 could approach $200. So that would be a doubling from a very low base last year. And that will be some momentum for the markets to continue and run with. We saw something else happen within the last week, and that was Treasury yields breaking out above 1%. This is the 10-year Treasury bond yield. And most bond observers and investors, I think, have been surprised at the power of the move through 1%. This seems to be breaking a long-term trend that many thought would not be broken for quite some time, especially because of the Fed's current monetary stance. The Fed has said it's going to stay, it would prefer to err on the side of ease at least through 2022. So with that in mind, the Treasury bond yield moving very rapidly through a key resistance point from the bond investors' point of view was quite surprising this early in the year. That has many people thinking or wondering what are the reasons. And we'll get into that in a moment when I go into more detail. What it does do is help with or make people wonder, are equity values, have the valuations gone too far, and now long-term interest rates moving up, which tends to be a dampener on valuations, are we now going to see valuations retrace given what's going on in the bond market? And again, we'll get into that in a few minutes. One of the nice things that has happened is, as I mentioned earlier, the equity bull market is broadening out with cyclicals joining the party. And actually, we're very gratified to see that. I think this is potentially a virtuous cycle at work. So now I'll go into the usual drill: monetary policy, fiscal policy, economic indicators, market indicators, and just a few moments on innovation. And by the way, we're having our market update next Tuesday. And so you will hear a lot more from us about innovation, and most of our analysts will be joining us as well. So please do join us for that. I think it's at 1:30 on Tuesday. Okay, so first with monetary policy, M2 is still up 26% on a year-over-year basis. We've never really seen numbers like this before. And so they're causing all kinds of questions. And of course, with the bond yield breaking out, and certainly 1% doesn't sound like a high number, but it is breaking a trend. The 26% growth in M2 is taking on new meaning, causing a lot of other questions. We do think this year, if we're right on both the magnitude of the cycle ahead, and the fears associated with commodity prices rising and the dollar falling, we do believe that the Fed is going to have to reassess its plans. We do not believe they will be able to remain, they will be able to remain neutral or easy during the next year, given the power we expect behind some of these moves. Copper prices, for example, are up 75%, a little more than 75% from the low in March. Now, of course, that was quite the low, but nonetheless, they have moved up quickly. They are still moving up, and the dollar is moving down. Those are early indicators that we probably will see more inflation than most expect. We think it's more of the cyclical variety, supply getting back in line with demand, and that it will not become endemic. And in fact, as we've said many times in the past, we think the deflationary undercurrents associated with the 5 innovation platforms and 14 technologies that are evolving at the same time now, those deflationary undercurrents are going to become quite powerful as electric vehicles and collaborative robots start to proliferate. Now, they're not at a high enough base yet to move the needle dramatically, but we do think they will scale dramatically during the next few years and get to the base where that deflationary pull really will be felt by the markets. One of the other things we would say if the Fed does reassess is that would be good news on our part. I know a lot of people would become quite concerned because it is a change. Nobody likes change. But just as we said during 2017, when the Fed was pushing interest rates up, we thought that was a good thing. We thought, wow, the Fed is comfortable enough now with what's going on out there to let the market work and not try and impose itself on the economic system. And we think that psychology will win out this year, but we do expect there to be some shudders or fears out there as the Fed does begin to change its spots. On fiscal policy, we do expect another $1 trillion. We hope that it will be targeted and that what we saw in the last package with 5,000 pages and so forth does not repeat. But once we're through shoring up those who have been devastated by this coronavirus, we don't think the economy needs any more stimulus. With what's going on in asset prices, particularly stocks and real estate, we think there's a lot of powerful activity out there and positive signaling that the stimulus will lead to nothing but higher taxes and probably will be much more wasteful. Now, in terms of the change in the administration and the shape of the House and the Senate now, very, very close between Republicans and Democrats. So Democratic sweep might be a little too strong, and I was even using that phrase. But now having to face the fact that we're dealing with a fully Democratic executive and legislative branches, we have to think a little more carefully about this. So in terms of the three policy priorities, I think, for the Biden administration, we certainly know infrastructure is one of them. And here is where he can enjoy bringing together Democrats and Republicans. There's bipartisan support for this. And I believe that the policies that President-elect Biden will pursue, at least in the beginning, are going to be somewhat more conciliatory than many expect. Infrastructure is one place we can come together. Healthcare, now we're very focused, as you know, on healthcare and the massive amount of innovation taking place in healthcare. President Trump's administration put into place two priorities when it came to healthcare. And I do think they will be in keeping with what President-elect Biden and his administration will want. Lower prices. And so generics and biosimilars will probably continue to get a push from the administration, a big push, in order to keep pricing down. But also the accelerated approval of breakthrough therapies. I think everyone wants that. Again, especially when it comes to cancer, President-elect Biden feels very strongly that we have to invest aggressively to overcome, that monster of sorts. So we don't think on that score that healthcare is going to change that much. We may get some attempts to move back towards universal healthcare and so forth, but I think that's going to be debated hotly. And then the final one, in terms of bringing the sides together, clean energy. Well, even the Republicans are beginning to understand that the costs of technology, like electric vehicle costs, so battery technology more broadly, are coming down to a level, and the technology is ready in many ways to scale. This has not been true for years and years. So the government has had to subsidize these areas in order to jumpstart them. We think that's going to be much less necessary, but to the extent this new administration pushes more aggressively in that direction, it will happen faster. And so there will be more debate there, to be sure, but I do think conciliation is going to be a priority of President-elect Biden. He has said so himself. The most damaging parts of his proposals or purported proposals are increased tax rates, and focusing on certain income levels. So the marginal tax rates, the highest ones, we have seen has not been a great strategy. Administrations in the past who have tried to do that have found that the tax base would disappear on them. And we're actually seeing this, it's in response to the coronavirus, but we're seeing a migration to low tax states that is very visible on both coasts. And I think that this new administration is going to, they're going to hear the other side of the debate in terms of what else will migrate. And as I've mentioned before, many times, it could be if they raise capital gains tax rates and corporate taxes and increase regulation again, that we will probably see a migration of innovation and innovative companies and creative people to other parts of the world, either back to their home countries and so forth. And our strategies are global in scope, so we will follow them. And so we're hoping this does not become a trend, but we do believe it is a risk. As far as economic indicators, well, I had an interview with Eric Schatzker at Bloomberg not too long ago, and he said, "Why the heck do you talk about the economy and policy and economic statistics?" I started this YouTube video in the depths of the coronavirus crisis. My background is in economics and finance. One of my mentors, as I've mentioned before, I think, on this channel is Art Laffer. So I have always had a point of view about what's going on in the economy, understanding the backdrop. I've always needed it in order to invest. I've always need the big picture. Some people don't need that, but I do. And we do have a point of view, and it did play out to our benefit, and hopefully to those of you who are listening to us, to your benefit as well, that we were going to go into a V-shaped recovery. And we were saying that quite early on as we described the coronavirus crisis as more of a shock to the system as opposed to a full-blown recession, which would spiral into a depression as the economy shut down. That turned out to be right. We're seeing autos, housing, capital spending have been soaring and have caused shortages in all kinds of supply chains, which the manufacturers are still trying to scramble and catch up. In today's employment report, while the headline was a very weak number, and it was weak, primarily because of the leisure and hospitality space, which in 1 month lost 500,000 jobs, just about that much. And we know why. So much weaker than expected. But what most headlines, and even some of the economists to whom I pay a lot of attention, they did not mention that if you parse through the report, you saw that manufacturing hours, employment itself was stronger than expected, and that manufacturing overtime hours went up. So this still tells us that manufacturers are scrambling to catch up with the housing market, the auto market, and even with China, because China has also gone through a V-shaped recovery. And even Europe is, despite the coronavirus, we're seeing signs of a pickup. And given the news over there, maybe I'm paying too much attention to the UK, but I would have thought that we would see a reversal in a lot of the statistics. We know that there are certain other sectors that are hurting. Commercial real estate certainly is one. And we think it has a lot to sort through, but we don't think it's a systemic problem. One other thing in the employment report that was very interesting was average hourly earnings increased 0.8%. I don't remember seeing a number that high, except in the late 70s, early 80s, when inflation was in the double digits. On a year-over-year basis, the average hourly earnings are growing 5.1%. And then on top of that, we're going to have massive stimulus during the first quarter. So the first quarter, I can't tell you what it's going to be in terms of GDP. Some of this depends on stimulus, but we could be in the teens as far as GDP growth. So again, V-shaped recovery, stoked by fiscal stimulus. We know that the equity market is a leading indicator for the economy, and the equity market, as I mentioned, the cyclicals, they're picking up nicely. And so that gives us great confidence that we're still on the right track. Inflation, I'm watching this very carefully. I think the complacency today around inflation, especially because it didn't respond to all the stimulus after 08, 09, meaning inflation actually continued. We had a little bit of a burst, but then it really continued to surprise on the low side of expectations in the 1 to 1.5% range. And so I think a lot of people think inflation is dead. I remember the last time I heard that was, I was very early in my career, and it was the late 70s. And I was speaking to portfolio managers who remembered that in the late 60s, many economists declared inflation dead. And it seemed like that was right for a few years. I would say the late 60s. And then in the early 70s, and especially 73, inflation kicked up royally as OPEC cut production and oil prices quadrupled. So that was the beginning of the unhinging around the US going off the gold exchange standard. We haven't done anything like that necessarily, but I would say monetary policy does not seem to be hinged to anything. And so there are inflation risks out there with money growing at 26%. The question is, will it be saved so that velocity keeps going down and maybe it continues to move into the asset markets, which is where we're seeing the real inflation, stock prices, housing prices? Or will we evolve into a psychology, could be gradual, but it'll be gradual until it's not, a psychology where consumers and businesses see inflation and interest rates starting to creep up, and they say, why don't I do this or do that before inflation and interest rates continue to move up? If that were to happen, then I think we would have an inflation problem. And it's the same thing as saying as the velocity of money would be picking up as people try and get rid of their dollars as quickly as possible in order to buy goods and services before they go up in price and before interest rates go up in price. If it turns out the money continues to move into asset markets, then the velocity of money will continue to fall, and it will take the risk out of that 26% growth rate. So watching it carefully, stay tuned. And then in terms of market indicators, well, I've just mentioned equities, the bull market broadening out. That's a very good thing, very healthy. I've mentioned interest rates, long-term interest rates, the risk-free ones breaking out, breaking above downtrend lines, which is very interesting because they have not done that. We've been in a 40-year bull market in bonds. Buying the dip was always the thing to do. When bond prices went down or interest rates went up, you should have bought bonds. That may not be the right thing to do anymore. Not sure. A lot of it a lot of it depends on what I just mentioned about money growth and inflation generally. We're seeing the yield curve steepen because, and what that means is long rates are going up, but short rates are not, because the Fed is holding them down. And so this is usually good for financial stocks, and in financial stocks have had a very nice run recently. But they are misbehaving today, and I can't figure out why. I'm sure there's a reason out there. Credit spread, so that's the difference between high yield or junk bond yields and investment grade yields. Those spreads have narrowed. And except in the commercial real estate market, there does not seem to be much worry out there about any stresses and strains in the system. There was for a time in the energy space, but even energy prices have picked up. We're over $50 now. And just one thing on that I'll say is that when you see OPEC cutting back production, you see Exxon shutting down production and writing down assets. What we believe will happen is we're going to be in a period of extreme volatility in oil prices. We still think the trend is down. The peak was in 2008. We're going to continue to see lower highs. But we'll see extreme volatility. If we're in a V-shaped recovery, we will continue to have a bit of a burst in oil prices. Secularly, though, we think, thanks to electric vehicles, the trend is down, and that trend will remain in place. I think another variable we're watching very carefully here is the dollar. The dollar dropped roughly 7% last year. So we in the United States lost 7% in purchasing power relative to other currencies around the world. We also lost a bit to inflation, but inflation is low and may even be overstated because the statistics don't capture the digital economy and the deflationary impact of the digital economy that well. But if it does break down from here, the dollar, it will be a major breakdown if you just look at a long-term chart. And it will force the Fed. It's another variable that will force the Fed to reassess its position, and perhaps the Treasury. So mentioning purchasing power on the innovation front, I'll just mention, I'll focus on Bitcoin. And as you know, Bitcoin has doubled in the last month or so. And it crossed the 20,000 peak from 2007 and has gone to 40,000. Well, what was very interesting this week, Jeff DeGraff, friend from RenMac, oops, excuse me, we have an interruption, sorry about that. Well, Jeff DeGraff from RenMac, he is a technician who also watches economic fundamentals as well as stock fundamentals, but he knows how to read charts, and he's seen a lot of charts. And he said this Monday on his weekly summary, he said, "I've never seen anything like this." He said, usually when there's a parabolic move like Bitcoin enjoyed in 2017, it usually takes a generation for that asset or that stock or what have you, commodity, to get back to that peak. And what he means by generation, he means 10 to 20 years. And the fact that here we are after 3 years, when I heard him say that, first of all, he didn't know what to do with it, but I thought, wow, I've never heard him say that. That means this has happened very rarely. And in fact, he does not recall anything else looking like this. So I found that interesting. But I think part of this, or the follow through, might have been triggered by, again, the bond yield doing what many people did not expect it to do, forcing all kinds of questions. have we made mistakes in monetary and fiscal policy that we're going to pay for in the future? And how are we going to pay for that? And most of us would say one of the ways typically is inflation, inflating our way out of government debt. And as you know, our preferred way at ARK of addressing this issue is to grow our way out of problems with innovation. So we're going to keep advocating for that, and of course advocate against inflation, because it is the most regressive tax of all. I do believe that just the questions being raised by, is this money supply too much? Is the fiscal stimulus too much? Oh gosh, the Treasury bond yield has broken above this downtrend. No one expected that. What's happening? One of the questions could be, should I hedge myself against inflation? And I believe there is no better hedge against inflation than Bitcoin. And as we know, gold has been moving, although now it's lagging Bitcoin fairly dramatically. So it's probably, there's probably some share shift, but I do believe that both of them will do well over time until we find out the answer to this question. And I also am taking some confidence from the fact that we have individuals and companies calling us about Bitcoin and other cryptocurrencies, saying, should we put some of our cash into Bitcoin? These are companies. And as you know, Square has done that, as has MicroStrategy. I think we're going to hear about more companies putting this hedge on their balance sheet as well, particularly tech companies, innovative companies who understand the technology and are comfortable with it. I also think that there's been more validation in the space when it comes to the regulators. So Brian Brooks at the OCC, Office of the Comptroller of the Currency, has basically said that public blockchains can be used for the settlement of transactions, and banks can become nodes on those public blockchains. Well, that was like a bolt of lightning. I just never expected it. And I don't think anyone else did either, except perhaps for some in the crypto world who were working closely with the regulators, which it clearly has been the case. So again, big validation out there. Now, this is going to help the banks cut their costs. But we do think that stable coins, which this will promote, are simply they're a bridge to what we believe will be more of a disintermediation of banks. And we will see more almost direct to consumer and businesses from the central banking systems of the world. So that will come in time, but in the meantime, this is a very exciting development. Certainly is getting everyone to study and learn much more about cryptocurrencies, blockchains, other crypto assets. And from an innovation point of view, we think we have miles to go. This is just the beginning. And to put that in perspective, today, I believe Bitcoin's the equivalent of market cap or network value is a little over $700 billion. And many people with it having doubled from 20,000 to 40,000, those sound like huge numbers. Actually, it's only a little over 700 billion. What does that mean? Well, Tesla is over 800 billion. These are both very big ideas, some of the biggest ideas I have ever come across in my investing lifetime, which has been a long time. So I've been in the business more than 40 years. couldn't be more excited about all of the innovation taking place now. Never seen anything like it. And I really do think some wonderful days are ahead for the exponential growth trajectories that are going to deliver superior investment returns, no matter what the environment is. We will have to go through our ups and downs, and certainly with valuations where they are right now, I'm sure we're going to go through a doozy of a correction this year at some point. I don't know when, and I don't know why, but I do know it never hurts to take profits and to keep some powder dry so that you have the psychological wherewithal when the world seems to be falling apart to pick up on bargain basement prices like the ones we got during the coronavirus. So Happy New Year once again. We're looking forward to sharing more of our thoughts with you each month, first Friday, and would love to hear any of your questions or suggestions or constructive criticism. Thanks so much.